Good morning, everyone. Welcome to this rundown for global stocks for the 6th of March. Last week, I was talking about the fact that the S&P index was sitting right at resistance at 1950, and I wanted to see how the market performed around that area. The week we've just had has seen another surge, and we're now at the next resistance level between 1995 and 2000. So a pretty impressive week. Commodities went higher, stocks went higher all around the world, and certainly sentiment has improved quite dramatically. If you compare the sentiment in the last 2 weeks to the first 3 or 4 weeks of January, it's quite a dramatic shift. So the question is, has the underlying trend changed, or is this just yet another one of those very, very sharp moves back in the other direction as the computers just kick the markets all over the place? So that's the question I want to explore in this particular video. So let's get stuck into it. So I just want to give you a bit of global background first, just really more from a big picture economic perspective. The rest of the world looks pretty precarious outside of America. We continue to see pretty disappointing data out of Japan, UK, and also to a degree out of Europe as well. However, America, none of the data suggests that America is doing really well, but then neither does it suggest that it's heading towards a recession either. So it's really just a continuation of what we've seen over the last couple of years, and that's fairly mild, tepid growth, certainly a lot less than what one would expect from all of the stimulus that central banks have thrown at it, but nevertheless it is growth. And the sectors of the US economy that are important, which is the consumer and the services sector, are they're doing okay. So I don't think we're going to see any very significant dramas from America from an underlying economic or fundamental point of view. Whether the markets go down for another reason, because they're looking forward, there could be currency disruptions, there could be bond market disruptions. Well, that's what remains to be seen. But there's really no reason for the American stock market to take a huge tumble. And I mean, that's what I've been saying for the last 2 years, that the fundamentals didn't support lower prices. But equally, when markets turn over, as they have with the S&P, you can't ignore that. Now, also on Friday night, the non-farm payrolls in America were quite strong, and they were good enough for the Fed to probably raise rates on March 16. Now, I'm not saying they will, but I don't think that those payroll figures will be poor enough to cause the Fed to hold off. So that's really quite interesting, because a lot of the weakness in the US dollar was because people had started to abandon expectations that the Fed would raise rates, and that may now be back on the table, at least to a greater degree. So the real question is, how will stocks and gold respond to that? We've already seen stocks did pretty well on Friday night, but also gold did pretty well. So normally stocks would go up and gold would go down. They would normally head in the opposite direction, because gold is really essentially a fear trade. People go into gold when they're fearful about being in stocks or other asset classes. And so it's really quite instructive to see both stocks and gold going in the same direction. So that's one of the big questions. There's another big question, which I'll get to shortly. Frankly, I don't know the answer to it, and I don't think anyone else does either, but that will certainly determine how things unfold over the next few months. Now, the index, the S&P index, rose by 52 points for the week. That's a strong week. So we've got still a continuation of this situation where we've got a short-term uptrend, albeit a strong one, but we still have a long-term downtrend. And the S&P really needs to close above probably around the 2030 mark to really shift that position from a long-term downtrend back into a sideways market or an uptrending market. So we're bordering a break of resistance. It's just kind of had a little bit of a peak over the top, but markets are overbought. So therefore, the chance of a bit of a pullback, 3 or 4 or 5% pullback, is certainly much higher than it was a week ago. But the real key for me always, and this is always an unfolding story, and that's why you have to remain flexible in your thinking. The key is how price reacts around this 2000 level. If we get just a mild 3% or so pullback, and then the market stabilizes and starts to go up again, then that would be pretty bullish, I would think. If the market pulled back to maybe 1950, we'll look at the chart in a minute, but if it just pulled back to that level, found support, and then started turning up again, I would read that as being pretty bullish. The other things that I've noted as well, there's lots of other indicators that I'm following. Breadth has improved significantly in the market, so there are now a lot more stocks trading above their 20-day and 50-day moving averages. So a lot more stocks participating in this rally. But amazingly, I just shake my head at this because it's quite incredible. The healthcare sector is lagging nearly every other sector, and in the short term, healthcare is even lagging the energy sector and the materials sector. You can only put that down to all the political rubbish that's going on at the moment, with all the politicians grandstanding about the cost of pharmaceuticals. The reality is that it's not going to come to anything for a couple of very practical reasons. One is the way that the American Congress and Senate is set up. Any politician that tried to get any kind of meaningful legislation against pharmaceutical prices through is going to fail. That would be the first point. And secondly, just from a commercial point of view, it would be the worst possible thing that they could do, because the healthy profit margins that biotech companies currently enjoy help pay for the billions of dollars of research and all the failed research efforts that go into developing life-threatening or cures for life-threatening diseases. So this is just political grandstanding. But unfortunately, it's thrown a really negative sentiment over the whole sector. And I don't know when healthcare will turn around, perhaps not until after the American elections at the end of the year. But I can tell you that they certainly continue to represent some of the highest earnings growth in the American market. And at the end of the day, stock markets track earnings more than anything else over the longer term. And if the healthcare sector is continuing to enjoy the highest earnings growth rates, then long term, that's where the opportunities are going to lie, in my opinion. But the other wild card is the price of oil, because we've got this almost 100% correlation between the price of oil and the direction of stocks. So it's really pretty much that simple. Now, if you can tell me where the price of oil is going, then you're a better person than I am, because I don't think anyone can have a great deal of confidence about what's happening with oil at the moment. We've certainly seen some short covering. Whether that follows through to more upside is completely questionable. So let's have a look at some price charts. We'll start with the S&P, and you can see this is where we were last week. We come up against the 50% retracement at 1945, and that's where we closed. We had one day down on Monday, and then it just shot out of the gates and went up for the rest of the week. And you can see we went straight through the 61.8% retracement, indicating some real strength. And we've just tucked in under these lows here from the 14th of December, finished right on that resistance level. We've climbed well above the 50-day moving average, and we're almost back up to the 200-day moving average. If we can get above, say, 2030, if we can get up around about here and close above it, then I would see that as a very bullish sign. So for the moment, wouldn't be surprised if we see a bit of a mild pullback, and it will be the nature of how the price reacts around this 2000 level that will really, tell me how things are likely to unfold. But certainly, there's a surprising amount of strength in the American market. You've got to say that in the last week. Up until last week, you could have said we're still in this big W pattern, but last week certainly did change that. Now, if we just look at the Russell 2000, so the small cap index on a weekly chart, you can see we had a very significant dip. We retraced exactly 50%, exactly. So markets are behaving technically very well. Got oversold, and then we've had a very powerful bounce. Now, one of the key levels for me here is around about 1,080, and we're right on that now. So certainly the Russell 2000, the small caps, looking much better. If you look at the NASDAQ, interestingly, the NASDAQ didn't go any higher for the latter part of the week. We had a big surge on Monday, but then it just stayed flat. So the NASDAQ was actually the worst performer last week for the majority of the week. And normally the NASDAQ will lead the market. So I'm still getting some very, very mixed signals. It's just so hard to pick where this market is heading in the short term because we are getting these mixed signals. We're seeing surprising strength in the Russell 2000. We're seeing a substantial rebound in market breadth, and yet the NASDAQ really quite a poor performer last week relative to the other indices. So I don't know how you read that. Now, I just want to make a comment about the seasonality because it does have a bearing. It's certainly not your primary consideration, and I would never trade or invest on the basis of seasonality because it's definitely a secondary consideration. But just for the record, March and April are two of the best months of the year, and 14 of the last 20 March periods have had a positive finish. The S&P has finished higher than it started the month. So certainly seasonality is in favour. And then, of course, once we get into May, then we look at May through to September as being the weakest period of the year. So it could be that we have another couple of months of strength, and then we might fade away after that. Now, how much exposure you have to the market really depends on your tolerance to risk. So, that's very much an individual decision. The question you need to ask yourself is the potential return to the upside, the further gains. Markets are already overbought in the short term. Is the potential return worthy of the risk? And that's always the question before you're about to invest. If you are waiting for all the risks to go away, which is what most people do, then you'll either never invest again or you'll invest at the top of the market when everybody gets really bullish and everyone starts to think that all the risks have gone away. So you can't do that. I don't think either of those alternatives is viable. If you wait until the market goes up to a point where everyone's comfortable, then you are perilously close to the top. If you don't invest at all and you stay in cash, then I believe that's a guaranteed formula that you're going to fall behind against the rate of inflation. So you have to make a call at some point when there is still an element of risk. It's just a matter of assessing the return versus the risk. The Aussie dollar was very strong last week. It rose 3 cents, or about a bit over 5%, which is a huge move for the currency. Finished above 74 and edged just above resistance. Now, whether it's a false break of a trading range, we'll have to see. But look, this is all about improving commodity prices. We'll look at that chart in just a minute. The ASX 200 index was up by 210 points for the week, so a big week. Still in the bigger trend, downtrending channel, but we're getting towards the top of that channel. And we saw all sectors back in favour last week. We saw the materials sector, the miners quite a lot stronger, but we also saw the banks rebound as well. So let's take a look at a few of those charts. So we'll start first of all with the Australian dollar. And you can see very strong week, gaps higher into each of those sessions. Yes, it appears to have just broken out, but it's a pretty close thing. And markets can have a tendency just to overrun a little bit. But I would note that for the first time in a long, long time, the dollar has gone above the 150-day moving average. So you can say that at least there has been some change. Now, short-term overbought, we could see an unwinding of all of this, particularly if the chance of the Fed raising interest rates in March takes hold. That will push the US dollar up and push the the Australian dollar down. So we'll just have to see how that plays out. Turning now to the Australian stock market. This is the mining index. So a very strong week after a dip to finish the previous week. This is finance, also a nice recovery in the banks, and wrap that up overall into the ASX 200, and you can see we've still got a big downtrending channel, which is quite definite. You can see that's quite a steep slope on that on the index. You can see the price is now getting towards the top of the channel. There's the midpoint there. Last week we came back down to the midpoint of the channel, but bounced off it and back close to the top of the channel again. And look, the Australian dollar will continue to trade very much in keeping with the dollar and also with the price of commodities. Talking about commodities, gold higher by $35 for the week. Stocks probably reversed from a short-term overbought situation on Friday night, which again would be normal and healthy. We've seen a substantial rise in stock values, but they're still nowhere near returning to the long-run averages. And that return to long-run averages is inevitable, but whether it's now or whether it's 2 years or 5 years' time, no one knows. It's just that all markets will return to those long-run averages in the end. So a substantial rise in gold stock values is ahead of us, but it's not guaranteed that it's now. So, don't get carried away with the possibilities in gold. However, it's really, really important to understand the drivers to have a better idea of whether this is just another rebound in an ongoing terrible bear market for gold, or is this the start of a new bull market? Now, I've put a lot of time and effort into really trying to understand what drives gold, who the various players are who drive gold, and how the relationships or the interrelationships occur between physical gold, between the gold futures market, between gold ETFs. It's really quite a complex web to try and unravel, but I've certainly got a better handle on that now, and I'll be sharing that with members over the next week or two, and also with with a game plan that I think is going to be a pretty good way to play gold. I think there's a good chance that there is enormous upside in gold stocks, but it will be volatile. It will get a bit scary along the way, and unless you really understand what's going on and how this is playing out, then it's not going to be all that simple just to walk up and buy some gold stocks. So members will get all that over the next week or two. Well, let's look at the gold price chart. So we'll look first of all on a daily chart, and you can see it was a pretty good week. We certainly continued the run higher, which is really, really interesting how strongly gold performed considering how strongly stocks performed. And that's unusual, to say the least. However, you can see the price of gold has been overbought now for more than a month without really much of a pullback. Whether we get another one now, whether this was a bit of a reversal on Friday night, it's hard to tell. We'll have to wait and see. This is gold looking a bit more widely now on a weekly chart, and you can see that it's now regained above the 150-day moving, or the 150-week moving average, I beg your pardon. So this is the 3-year moving average, and it hasn't been there for quite some time. You've really got to go back to 2013 before it was above that moving average. Let's look at a couple of gold indices this time. This is the HUI index. So clearly moved above resistance and performed very strongly, but quite a decent old reversal on Friday night from looking extremely buoyant. And same sort of pattern on the GDX index. So I wouldn't be surprised to see pullback in gold stocks for anywhere between a couple of days to a couple of weeks. But look, that would be a healthy thing. Copper firmed again to 228, partly about the US dollar and partly about a renewed enthusiasm for commodities. Crude oil was up to 36. Look, I don't know what the heck's going on at the moment. On the one hand, I look at the strength in crude over the last week or two, and you could say, well, the price gain has been so strong that tells you something. But when I stood back and just reflected on how markets have been behaving over the last year or two, all the moves seem to be so emphatic these days because computer algorithms are driving everything and hedge funds are just pushing markets rapidly from one extreme to the other so that they can make money. So I'm less inclined to get sucked into this big price rise in oil, particularly when, to my mind, the fundamentals haven't changed. You've still got a substantial oversupply. It's hard to see what's going to correct that. I can't see the Saudis backing off. And we'll just have to see how it plays out. There's still a massive inventory to be worked down as well. I just can't see fundamentally why oil should sustain any sort of uptrend. Here's a couple of oil charts. You can see this is the 3-month chart. So we're right now at the top of the trading range. Sort of just broke it a little bit on Friday night, but really needs a bit better finish than that. And to put it in perspective, there's the 12-month chart for West Texas Intermediate crude oil. And just going back to what I said before, crude oil and the S&P trading basically with 100% correlation. So if crude oil does break out above 36, which defies the fundamentals, but could happen, then that will certainly mean that stocks will be going higher from here. There's the spot copper chart. You can see quite a strong rise over the last week or two. So it's copper done very well. Just wrapping it all up, the overall strategic approach, and look, this is the same slide as from last week because really nothing has changed. The only way to deal with this market is to work from the extremes of price and sentiment. Don't try and be involved in the market the whole time. Don't try and be a hero and pick direction in the short term. Just let the market move to extremes and work from there. Don't stay in a position too long because the market's likely to reverse and just run back over the top of you. And overall, taking steps to reduce your risk and your volatility in your portfolio. There are definitely things that you can do. If you just stay with valuations, yeah, they still matter, but the trends are far more important. And if you're not following chart patterns as well as the fundamentals, then I think you are missing the most vital element of all. So that's it. Another really fascinating week. I'm sure the next week will be pretty much the same. For anyone who's not a member of my group and would like some assistance with what they're doing, there's my contact details. Always happy to communicate with you. And that's it for this week. So talk to you again next week. Cheers.